Stockwatch is brought to you by Merchant Waste. Where others stop, we push further. Because we believe business as usual doesn't lead anywhere new. Go beyond with Merchant Waste. Finance, invest, insure.
You're watching Stockwatch this week. I'm Ndawling Lechela, and joining me to unpack your stock-related questions today are Nader from Benguela Global Fund Managers and Jean Pierre Verster from Protea Capital Management. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392, or on X at Business Day TV using the hashtag Stockwatch. Gents, thanks so much for your time this evening. Let's get straight into it, right? Now, as we are heading into the festive season, we've just come out of Black Friday. There's a question here around which companies you expect to win during the season. Also reflecting on those GDP numbers, we saw household expenditure still coming through strong, I think up 0.7%, with food and beverages as well as household equipment and furnishings coming in strong. Do you think those counters will be the likes to benefit over this period, JP?
Yes, darling. So you mentioned household goods and furnishing. So I think a company that might do well, but also equally importantly, it's not necessarily in the share price yet. So, you're looking not just for a company that might do well. If the company shares are expensive, then it might not be a buy, even if the company does well. But a company that I think can do well, but the shares are relatively cheap, is Lewis. So they obviously they've got a leading position in the, call it, lower end or more value furniture and equipment business. They're in a bit of a tussle with Pepkor regarding that acquisition of the furniture assets of ShopRite. But in the meantime, they're rolling out new stores, especially in the bedding sector, but also in other core furniture brands that they own. And very cash generative. The ROEs are now meaningfully higher than the cost of equity, which means you can justify a higher share price, a higher price to book. So it's still trading at a discount. So I would pick Lewis, and then obviously people need to eat and drink. So you can look at companies like Famous Brands and Spur as well. They'll probably also do quite well over the festive season.
Let's get your thoughts around that, Grant. I was also going through some data out from Standard Bank that noted that the highest spend on a credit card was spent on home furnishing. So we are seeing over that Black Friday period that consumers were spending on big ticket products.
Yeah, there was definitely an element of that. And to JP's point about Lewis, they're offering credit. And those guys who are opening the taps on the credit are seeing the volume come through, because ultimately the consumer's actually still quite tight at the moment. The other thing we saw with the Black Friday sales is people are still spending a lot more on essentials than luxury.
Yes.
So there were less of the TVs and the whatever else, kind of luxury goods, and more of the stuff they need. So that tells you the consumer's not yet feeling super comfortable, but we have to accept that things have to be easing. We've seen the rate cuts. Inflation is behaving itself. Food inflation is also somewhat benign. And so I think I would say that sort of sector would also do well, like food and beverage, somewhere around essentials and maybe marginally luxurious, and that's where the Famous Brands comes in. Of course, they're going to compete with gambling. That's a bit of a problem. And the other area we've seen do well, that probably continues to do well, I think, is the motor vehicle sales, with the accessibility of cheaper cars, new cars. The Chinese cars are driving increased volume sales of new cars. So those are areas where I think we'll continue to see good consumer, consumption, let's say.
Those new new vehicle sales numbers have been so surprising. You're even seeing pressure coming through when it comes to the used vehicle market, just reflecting on Motus's numbers, We Buy Cars' numbers. Is that still a space you're looking at getting into, JP?
Yes, I do think it's quite interesting to think about what the cheaper but still quality Chinese vehicles have meant to the market. One of those opportunities, I think, is We Buy Cars. I think people might have gotten a fright because of the lack of growth in the second half of their previous results, and thinking there might be a structural change in the market. But in my mind, it's a once-off adjustment, and I believe they've made that adjustment. So they cleaned out the more expensive European brand stock that they had as quickly as possible, and maybe they took a little bit of a margin hit on those. But now the stock is clean, and now they'll probably in the next year or two start buying these Chinese vehicles secondhand.
Yes.
And then the cycle continues. So I think structurally, We Buy Cars is still in a strong position. And then a motor vehicle dealership like CMH, with quite a few Chinese brands, I think is also an interesting one. They've got a pro rata share buyback that's happening in next month or two. So people can decide to cash in some of their shares. I probably won't. I think there's a lot of value in the shares. So I'll rather increase my holding through other people selling their shares back to the company. So those are two opportunities, I think, because of these Chinese vehicles coming into our market.
Coming in and, buying the dip when it comes to those counters. I want to circle back to the retail sector, Grant, with you. We talked about spending, and what we're seeing is essential spending taking place. A question here on SPAR. I think it's one of the retailers we sort of forget about, right? The group still within that restructuring process, and also making moves when it comes to its exposure to the pharmacy sector. Is it a good buy at these levels?
Well, look, it's cheap. I think they've still got a good brand and a good foundation, but they're really struggling because they're getting hit from a lot of sides. They're behind the curve in the online delivery. Checkers 60/60 is leaps and bounds ahead of everyone, including Pick and Pay and Woolies. And then they've got, they've retreated from some of those overseas operations, which I think was an excellent move. Focus on the core, but they've got, look, so there's self-help, but you can see they're losing some market share. So while they are cheap and there's opportunity to unlock value, there's a lot of execution risk. I've also seen they're going after some of the other areas where the other guys are playing. They're now going after pets.
Yeah.
They're going after market space. They're going after some of Woolies' target market, which is well and good, but, on the one hand, but you can't be everywhere. I'd rather management just focused on really just getting that core back into its traditional strengths, and rather not try and compete on every front. So I'm a little bit cautious. I think there is value, but I think it may be a value for a long time. And so I would probably wait on the sidelines on this one for now.
Wait and see on SPAR, or are you nibbling, or are you looking at its competitors? We speak about ShopRite, there's Boxer as well.
Yeah, so I'm with Grant. I would also rather wait on the sidelines with SPAR and see the turnaround get a bit more traction. They probably need to spend a bit more money on the operations after they needed to sort out all the other issues that they had. So I think ShopRite looks good for me, and Boxer looks good for me. So I prefer the lower end of the market. We spoke about necessities a bit earlier. So that value offering on necessities that Boxer has and ShopRite has with the ShopRite brand, but then also with the Checkers brand starting to really compete with the more premium outlets of Woolies, for instance. I think those two retailers in the food space are my preference rather than the likes of SPAR.
And just on ShopRite, JP, we touched on Checkers 60/60 with Grant, and I'm wondering whether the Walmart presents competition on that front, as it also launched its delivery service in the country.
Yes, I saw they said with the two new stores they've opened, Clearwater Mall and in Four Ways, that there's going to be delivery of goods within a certain radius. So that's going to be very interesting to see as they roll out more Walmart stores, if they'll roll out that and get more coverage. They'll probably start with the densest areas in Gauteng. Who knows? They might open something in the Cape as well. And it'll be a slow rollout, but still it's a lot less coverage than the likes of Checker 60/60 and even Mr. D in association with Pick and Pay.
Yeah.
So I really still think even if Walmart and via Massmart invests a lot in their delivery offering, they are far behind the likes of Checker 60/60 and even behind Pick and Pay with their link up with Mr. D.
All right, so still a long way to go for the likes of a Walmart here at home in SA. And talking about local markets, Grant, do you think we will see a deeper correction on the Aussie, perhaps 10 to 15%? The JSE, of course, has had a good run on the back of higher precious metal prices, in particular the likes of gold, PGMs.
Look, I hope for all of our sake we see a 10% correction, because it's a bull market, right? And you want corrections in a bull market that keeps it healthy. I mean, we've done 37% this year, or give or take, depending on which index you look at, which is quite phenomenal. And yet we've still got a lot of value. So if you see a correction, it'll probably be led by the resources and the precious and the gold, which mostly took us higher. And it doesn't, and hopefully that they sell some of the other quality names, like the financials, etc., down with it. You should be buying. So I think a correction is just part of the journey. It shouldn't be something we'd be concerned about. Whether we have it in the next month or in the next year or 6 months, it's anybody's guess. We're usually driven by what's happening globally. And so if we see some kind of correction globally, which we had a brief one this last month, but that didn't last very long, then we'll probably see one here as well.
And we know that rally, of course, being fueled by the likes of Naspers, Prosus, as well as the miners, in particular PGM and gold miners. But I want us to take a look at the copper, right? We have a question here around copper 360, but I do know that both of you don't look at that counter. So maybe let's help out the viewer and perhaps give the viewer some suggestions on where to look when it comes to copper exposure. We do know that Anglo is, in the midst of a deal with Tech Resources. Harmony Gold has that acquisition with Mac Copper in Australia as well, JP.
Yes, correct. And I'll throw BHP Billiton also in the mix. They've got, well, not really. They try to get more copper with Anglo. So let's scrap that. But Glencore has got quite a bit of copper. So there's a few South African commodities counters you can look at if you want copper exposure. You can also go offshore, Antofagasta and a few other miners listed in London if you want some more pure play copper exposure. A lot of people think copper is well placed because it's primarily used in electrification and through renewable energy and the whole movement of installing new sources of electricity. We will probably need to do more wiring, and that wire will probably be made of copper. So this whole electrification and journey we are having to a green transition away from traditional coal and other fossil fuels to more renewable energy could be very good for copper. But then again, there's a lot of copper around. So I'm not a big fan of commodities. It might be a decent commodity to have exposure to, but I think, in my opinion, there's enough companies with business models and pricing power, and they can decide what to price their product at, rather than just being exposed to the vagaries of world markets of the commodity that they sell. And those are the type of companies I prefer. So yeah, I'll leave the copper to the viewer, and I'll stick with my industrial and financial stocks.
Okay,
Thank you
all
very
right.
much.
Grant, let's get your views around copper, right? Where are you sitting when it comes to that? Where do you like your exposure to be? Would it be within an Anglos? Would it be within a Glencore?
We've been constructive on copper for quite a while now. I think it is a metal for all seasons, as JP said, electrification. We know the increasing energy demands for this data center build out related to AI. And you've got to have transmission lines and grids and all that sort of thing that connects everything. EVs, you name it, copper's involved, even traditional infrastructure, and buildings, etc. So the demand story is very robust. Yes, there's a lot around, but also supply is slow to come online. I think the supply-demand balance is still favoring a better market for copper. So we're still positioned for that. I think Anglos has been our top pick. Glencore, I think, is a good one as well. We prefer those two as a copper entry. I mean, I know Glencore, you get coal and cobalt, some other interesting resources, and Anglos is predominantly, especially if the tech merger goes through, I think it's about 70% copper and the rest iron ore. I'm not sure the exact number. So you're getting almost a pure play. So those would be our preferred picks in this space.
Okay. One more question around the resources. A viewer asking, why are we seeing a plunge in Sibanye's share price? It's down 4%. Is this on the back of the lower precious metal prices or on the back of the wage deal it just sealed, Grant?
I didn't see the wage deal. I would say the whole sector, I think, was down today. I suspect it's more related to a pullback in the prices after a very strong move. If you take that 4% in the context of the last couple of weeks, I don't think it's a big move. So
yeah, nothing to be too worried about then. JP, let's talk Naspers, currently down close to 17% from the recent high. Would the panel be able to pinpoint any reasons for this decline? Is it just a healthy pullback here?
Yes, I think it's healthy. But in terms of the reasons, I think firstly it is Tencent. Tencent is down as well in Hong Kong over the last few weeks. But secondly, the discount has increased a bit. So the drop in Naspers has been more than the drop in Tencent. And to some extent, that is because of the management team indicating that they're probably going to slow down the share buyback. And a lot of people like the share buyback. So a slower share buyback, people would say, is something they like less. One understands that Naspers still wants to have a meaningful say at Tencent. They still want to be able to have, 2 members on the board. And if they keep on selling Tencent shares to buy back their own shares, even though it makes financial sense, they lose influence at Tencent. And at some point, Tencent might say, hey, do you really need so many board seats? So I understand the situation, but that means the discount is going to widen. And that means that Naspers is going to underperform Tencent. Until the rest of the Naspers operations come on stream, the likes of Just Eat, we had a change in CEO today. The founder stepped away, not great, but these things happen. And then some of the other operations around the world need to make a more meaningful contribution so that Naspers' performance can actually keep up with Tencent. But until that happens, and Naspers is still Tencent minus, not yet Tencent plus. So we look forward to 2026. Hopefully we can talk about Naspers in more positive terms than just being Tencent minus.
And the group has, of course, been trying to reduce its reliance on Tencent. That, taking place at a slower pace than expected. Just your thoughts around, Naspers Prosus and where they're at when it comes to the contribution from Tencent into the earnings there, Grant.
They've actually been doing a very good job of trying to transform it to beyond, as JP said, just Tencent. But it's a long journey. Tencent is a massive investment. The last valuation I saw on basically the rest of the assets is sitting at around 800 billion rand, which is a big number, but actually not that big in the context of the Tencent valuation in rands. So they've still got a lot of work to do. I think the last update, it wasn't quite as strong in terms of momentum around generating cash from the rest of this, or the rest of the classifieds and the delivery. And I think there was a little bit of disappointment there, along with the lack of buyback impetus, etc. So there's been a slight derating. Also, Chinese tech has had a breather as well. So I think there's a number of factors. I think the core investment thesis, just around Tencent alone, you can still build a very strong investment case. And then I still think they are doing the right things. I like the new CEO, that Brazilian guy, and I think he's doing a very good job. There's a very clear vision. So I'm still comfortable holding this one.
And Fabrizio has such a booming Instagram. I think he has 50,000 followers. So yeah, he's not just bringing in the money in the company. He's also entertaining everyone else on social media. Yes, he's an influencer. Let's move over to the construction sector, Grant. WBHO, your opinion on the group. Viewers saying it had good results, but we're not seeing much movement when it comes to that share price.
Well, look, I think the construction space in SA has been very tough to navigate. WBHO has done one of the better jobs out there. Yes, they had some business in Australia as well, which they've done okay there. I think they had a wobble there in the last year or two, but generally speaking, it's a good management team. It's a well-run business, but they are still tied to the build-out in SA, and the SA government has been very slow to roll out its spend in infrastructure and the like. And I think that's going to be the catalyst for the whole construction space, is when South Africa gets its act together. So, and in that environment, I would like a company like WBHO would be one of those that I would look to, just because I think it's a higher quality than the rest. But I'm not deeper in the weeds than that.
Okay. What about your thoughts around the construction sector, JP? I remember talking to the CEO of PPC, who said that they are seeing sentiment slightly improve, which could then possibly lead to more volume growth when it comes to cement. But let's talk about the players in that space, the likes of a WBHO, or would you be looking at maybe another player that has some exposure there that would be something like a Raubex?
Yes, so I think those are basically your three options: WBHO, Raubex, PPC, if you want exposure to construction. And between the three, all decent companies, decent opportunities, especially if we get an uplift in infrastructure spend. It probably also depends on what type of spend. The likes of Raubex and WBHO have got significant road exposure, while obviously cement goes into all kinds of general building, including bridges and residential construction and other construction. So yes, look, I like construction more than I like mining.
Okay.
But still, I mean, if you go back 10 years or 15 years, we had like more than 20 construction stocks listed on the JSE. And now we're talking about three construction stocks. Just about all the other construction stocks, the actual contractors went out of business. And the cement market has been decimated as well. If you think where PPC was trading previously 10 to 15 years ago. Yes, WBHO and Raubex are the only two men standing. So if you want exposure to construction contractors, you can buy them, or the materials, you can buy PPC, but you need an uplift. If we don't get a proper uplift in activity in South Africa, it could be dead money for the next 10 to 15 years.
Let's move over to a sector that's been doing fairly well, which is the property industry. A question here on Equitas. There's two parts to it, so I'll start with you, JP. Does the accelerated book build at only 1.3% discount signal strong institutional confidence?
Yes, it does. So very slight discount. And also, they didn't announce a specific project where it was going to be accretive, for instance. So that shows that the institutional market trusts Equitas and the strategy they're following. And it would be good for, there's a reflexive process when it comes to real estate investment trusts. The slighter the discount at which they could raise capital, the better for the NAV per share. So a slighter discount actually pushes up your value, which makes it easier next time to raise capital, which then pushes up your value again. And you can get a very nice virtuous cycle going, like we had 10 years ago, 2017, 2018, before it popped. There was a virtuous cycle when it came to these real estate investment trusts raising capital. So the signs are there that we might go into a similar cycle, probably not quite as strong, but it is positive when real estate investment trusts can raise capital at such a slight discount. And it's a win for the current shareholders as well.
All right, so we can't get into the second part of that question. So I'll head over to you, Grant. Where are you seeing value at the moment? What's your stock pick?
So my stock pick is tied to the insatiable demand for power and energy that's growing, and it's being supported by not just a normal growing economy, but by the demand for AI supported consumption. So, and specifically in the US, the only way they're going to create the baseload to support the demand coming from these data centers is through LNG, liquid natural gas. The waiting list for gas turbines is 4 to 5 years now. There's such a lot of demand. But LNG prices have remained fairly subdued because it has been quite plentiful. But I'm betting, and I'm taking the view that supply-demand balance is starting to tilt, and that over the next 12 to 18 months, the demand for Henry Hub natural gas, which is the US natural gas, is going to turn upward meaningfully. And the way to play that is through EQT Corporation. They're the largest natural gas producer in the US. And I think they're very well positioned to benefit from that. Operating well, the healthy balance sheet, etc., all along anyway, but well positioned to capture what I think is a long-term upside story in LNG.
All right.
So that's my pick. EQT Corporation.
EQT Corporation for Grant.
Yeah.
What about you, JP?
I'm also picking an offshore stock, one listed in Denmark, Novo Nordisk. I did choose it also earlier this year, and it's one of the biggest pharmaceutical companies in the world. Between Novo Nordisk and Eli Lilly, they dominate the weight loss drug market and insulin drug market. And Eli Lilly has just completely dominated Novo Nordisk when it comes to winning market share and coming out with better products. And Novo Nordisk have really done a lot of bad things. They've had own goals. They forgot to register some of their patents, like in Canada. And that negative sentiment has really driven the share price to quite low levels. Now, I think other than the GLP-1 drugs that they have, the weight loss drugs, the insulin franchise is still very strong. They're still developing other drugs as well. So the market is very, very negative, and I would say perhaps unduly negative, overly negative, regarding the prospects of Novo Nordisk, given all the other drugs they have, and hopefully we are near the end of all the market share losses when it comes to the GLP-1 drugs.
All
So
right.
this relatively low price, I
Yeah.
would say Novo Nordisk looks interesting.
All right, let's leave it there. JP, Grant, thanks so much for your time this evening. And that's all for Stockwatch today. My guest, Grant Nader from Benguela Global Fund Managers and JP Verster from Protea Capital Management. Up next, it's The Close. Stay watching.
Stockwatch is brought to you by Merchant West. Where others stop, we push further. Because we believe business as usual doesn't lead anywhere new. Go beyond with Merchant West. Finance, invest, insure.